a couple of cuts or maybe more kind of thing. The reason we're not is the forecast by all professional forecasters that I know of on the outside and the Fed do expect a meaningful increase in inflation over the course of this year.
Donald Trump woke up in a cranky mood this morning, and I know that because he only got about 5 hours of sleep in between hysterical tweets. The last thing he posted before laying his head down on his orange-stained pillow last night was this: "Too late, Jerome Powell of the Fed will be in Congress today in order to explain, among other things, why he is refusing to lower the rate." It's crazy that he said in Congress today, and it's 12:32 a.m. These morning rants are getting earlier and earlier. We should be at least 2 to 3 points lower, which is an absolute insane request. No wonder this guy has like 8 bankruptcies under his belt. I hope Congress really works this very dumb, hard-headed person over. We'll be paying for his incompetence for many years to come. The board should activate, make America great again. Well, unfortunately for Trump, that's not what happened. Jerome Powell instead dropped bombshells on Trump during his testimony in front of the House Financial Services Committee on the semi-annual monetary policy report. Check it out.
In September of 2024, with core inflation still being above target and the labor market was holding steady at the time, the Fed made a decision to cut rates by a full 0.5 percentage point. It kind of raised some serious questions as to whether or not the data truly supported such a move at that time. And I think some of us were surprised that it was a full 0.5%. So can you revisit that again, what the Fed was thinking at that time? Because it seems to be somewhat of an enigma now. It stands out as, why was this done? Why was the 0.5% done at that point?
I'd be glad to. So, first of all, actually the inflation and employment readings were very similar then to what they are now. They weren't terribly a tenth or two.
Right.
But the difference then was, you mentioned that the labor market was stable. It wasn't. The unemployment rate had actually gone up almost a full percentage point. I was very clear about this. We were very clear about it in real time too. The concern at that time was that there really hasn't been an experience, or hadn't been an experience in the modern era, in which the unemployment rate has gone up close to 1%. That hasn't been followed by much higher levels of unemployment and a recession. So we were looking at that and saying, and remember, at the point we're talking about, the federal funds rate was 5.3%, so definitely a very restrictive level. We were the last of the big central banks to cut. So we wanted to make a statement that we were supportive of the labor market and not just inflation. We've been focusing on inflation. I was quite clear about this. So it was all about the labor market. Inflation was the same and unemployment was roughly the same, but it was the rate of change with the unemployment rate that raised a lot of concerns. And remember, we were being criticized for being late to cut. So we could have done 25. If we'd done 25 in July, we were criticized for not cutting in July. Instead, we cut 50 in September, and it seemed like the right thing to do. And at the end of the day, we do what we think is the right thing when we think it's the right thing to do. We don't take into consideration political factors. If we start doing that, I don't know where that stops. Once you start considering elections and stuff like that, where does it stop? So
no, and I didn't want to insinuate that it had anything to do with the election itself, but there just seems to be some very similar numbers right now. And I'm wondering, and I don't bring this up because I want to kind of make a point about did the Fed do the right thing or not. I bring it up because it seems like everything's in place right now to kind of do the same thing, make the same move. I know this morning already you've talked a little bit about where you were on inflation right now and kind of what you're watching, but is there any lesson there? I mean, are we in a position where it would be appropriate to do something as big as a 0.5% cut again?
Well, look, as I said earlier, if you just look at the basic data and don't look at the forecast, you would say that we would have continued cutting. The difference, of course, is at this time, all forecasters are expecting pretty soon that some significant inflation will show up from tariffs. Now, we can't just ignore that. But we're not. We're just saying let's wait and see more. That's all we're doing. And if you will have noticed, a substantial majority of the committee has written down rate cuts in the remaining 4 years, four meetings this year. So it's just a question of being prudent and careful. But at a time when the labor market is still strong, we don't see weakness in the labor market. If we did, that would change things. You know, we're going to continue to adapt as the data adapt. But that is the difference between then and now. Then inflation was forecasted to continue to come down. Here it's forecasted to go up by all forecasters. So, and again, we're not overreacting to that. We're just saying, hey, as long as the economy's strong, we can take a little bit of a pause here. And that's what we're doing. And again, continue to adapt as the data comes in. If we see data that suggests that inflation's not going to produce big increases, you know, that would matter. And if we saw the labor market weakening, that would matter too. But we don't see those things.
So what is it that's keeping, in your mind, the Fed from what many of us believe is the right thing to do, which is to lower some interest rates and, by the way, match what the Bank of Canada, Bank of England, the European Central Bank, the Swiss Central Bank, a number of emerging central banks. By the way, that's your own assessment on page 33 as where you're laying that out. Why aren't we doing what the rest of the world is doing? Is it because we're at full employment? Is it because of those tariffs concerns that you said weren't part of the analysis? Was it energy, groceries, durable goods? Why?
So you're right that if you just look in the rearview mirror and look at the existing data that we've seen, you can make a good argument that that would call for us to be at a neutral level, which would be, you know, a couple of cuts or maybe more kind of thing. The reason we're not is the forecast by all professional forecasters that I know of on the outside and the Fed do expect a meaningful increase in inflation over the course of this year. When I said we weren't going to talk about tariffs and inflation, that was to say until we see what the policies are. And so now we know a lot more. It's 6 months since I said that. So anyway, I'd be happy to continue this with you.
Thank you.
Do you believe that we are in a position where we may be able to cut rates in July?
So I would say this. I think if it turns out that inflation pressures do remain contained, then we will get to a place where we cut rates sooner rather than later. But I wouldn't want to point to a particular meeting. I don't think we need to be in any rush because the economy is still strong. The labor market is strong. If we were to see the labor market, you know, meaningfully weaken in a way that was concerning, that would matter for that decision. But if we see inflation, you know, continuing not to move up, we hadn't expected inflation to move up much. We do expect it to move in the summer, and if we see it not happening, you know, we'll learn from that.
The September 2018 Teal book suggested that the Fed, seeing through tariffs' inflationary effects, is an appropriate response so long as inflation expectations are firmly anchored and that the pass-through costs are relatively short-lived. Would you agree that this assessment from the Teal book still applies to today?
I would. Those are the exact factors that we cite when we talk about this situation, plus the size of the tariffs.
Right. So let's assess the current economic situation. The Monetary Policy Report states that longer-run inflation expectations, quote, continue to be broadly consistent with 2% inflation, unquote. And a Harvard study argued that despite the relatively quick price responses to tariff announcements, the overall magnitude of these changes remains modest. So if these conditions hold, is it not unreasonable to think that underlying inflation trends should continue its path towards 2%?
That's certainly a very defensible position. I think what others on the committee think, and what I think, is that this is a question we need to be careful with because it's different than it was in 2018. The difference is that we haven't had 2% inflation. In 2018, we hadn't had an inflation as high as 2% for a decade anymore.
Right.
This is a different situation. We haven't fully restored price stability, and another shock. We have to be careful. If there's a meaningfully large and sustained inflation shock, we have to be careful about that. And so, you know, I think we're just trying to be careful and cautious, and we really think that's the best thing we can do for the people that we serve. If that happens, we need to be there for it. And so, you know, we're in a difficult situation in deciding exactly when to move. But again, if we continue to see inflation come in, you know, and not prove up at the high levels that we higher levels than we expect, then that would matter for our decision making.
I appreciate that it's not your role to comment on the advisability of specific policies, but given your critical role in ensuring price stability and reducing inflation, I have had conversations with, quite recently, just a week ago, with a C-suite executive of a major global retailer who informed me, because I asked, why aren't we seeing the impact of these tariffs and price data yet? And he said, it's coming in the third quarter, because it takes time for tariffs to work their way through a distribution chain. Often what you have on the shelf today may have been imported 2 or 3 months ago. Is that your understanding? Do you anticipate there may be impacts down the road?
Yeah, that's very much what I hear. I happened to meet with an unusually large number of business people in this last FOMC cycle, and that's a typical thing that they'll say, especially the retailers, that what's being sold now was in inventory in February, let's say, and it just isn't showing up yet. So we do expect to show up, tariff inflation to show up more, but I want to be honest, we really don't know how much of that's going to be passed through to the consumers. We just don't know, and we won't know until we see it. It could be lower than we expect. It could be higher. We have to wait and see, which is kind of what we're doing.
I appreciate the uncertainty. Another thing he told me that had me very concerned was that often they will increase prices on goods not subjected to tariffs to compensate for the very substantial losses they have to suffer with the increase of tariffs on relatively price elastic goods. So in other words, necessities will also tend to bear a higher price, even if they're not subjected to tariffs. Is that your understanding of the potential impacts?
That very much is something that companies will tell you that they do. If they can't cover the losses on the thing that's being tariffed, they'll find other ways to do it. We actually don't have prominent examples of that yet, but that's certainly a possibility. And that did happen in the last tariff episode with washing machines and dryers.
Thank you, Mr. Chairman.
The Trump administration has championed the unitary executive theory, the notion that the president has absolute power over all entities that wield executive power. That theory, if taken to an extreme, would all but abolish the independence of the Federal Reserve. If monetary policy became nothing more than an expression of presidential will and whims, what havoc would that wreak on the U.S. economy?
I think that independent central banks have proven over time to be a valuable and critical institutional practice. And I think that is because basically advanced economy democracies around the world have given their central banks a degree of operational independence. They assign them goals. You go do this and you stick to those things, but we'll let you may choose the means of achieving those goals. It's called instrument independence, but not goal independence. And I think it's a very
Gentleman's time has expired.
Very important practice.
Gentleman's time has expired. Chair now recognizes our last.
Now, Trump is having a pretty busy day today, saying as the war he started is looking like it's not going to stop, even though he wants it to in order to get that Nobel Peace Prize. But once he realizes that Jerome Powell just said what he did, he's not going to be too happy. Luckily, there are still some responsible adults at the helm of this country. God bless it. I'm Tony Hinderman with Really American, and I'll catch you next time.